Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is March the 14th, 2026. Last week, we wrapped up our 14-episode journey through the world of debt securities. This week, we're turning our attention back to stocks. Between October and November of last year, we traced the history of equity ownership from Roman Publicani through the Dutch East India Company all the way to smartphone investing. We covered 2,000 years of history, but we never got into the mechanics. How do stock prices get determined? What happens when you tap buy on your phone? Today, we start answering those questions, and the key to understanding all of it is one word: liquidity. So, where do we start? On May the 17th, 1792, 24 stockbrokers gathered beneath a buttonwood tree, what we'd call a sycamore tree today, on Wall Street in Lower Manhattan. They signed a simple 2-sentence agreement. They would trade securities only with each other and charge a fixed minimum commission. No building, no trading floor, no regulations, just a handshake deal under a tree. But that agreement created something invaluable. By concentrating buyers and sellers in one trusted group, those 24 brokers made it dramatically easier to trade. They created liquidity, and that changed everything. It's another example of the pattern we've seen throughout this series: informal gatherings evolving into formal institutions, just like Jonathan's Coffee House becoming the London Stock Exchange. So, what exactly is liquidity? Liquidity is the ease with which you can buy or sell an asset without significantly affecting its price. A liquid market means that you can trade quickly at a fair price. An illiquid market means you might wait days for a buyer or accept a steep discount just to get a deal done. Before organized exchanges, finding a buyer for your shares was like trying to sell a used car without the internet. You had to know someone, negotiate privately, and hope you are not being taken advantage of. The Buttonwood Agreement created a central meeting place where buyers and sellers could find each other reliably. And here's what makes liquidity so important. Without it, ownership becomes a trap. You might own shares in a wonderful company, but if you can't sell those shares when you need cash, your ownership isn't worth nearly as much as you think. Liquidity is what makes the difference between owning an asset and owning a useful asset. It's the reason the Dutch East India Company's transferable shares were so revolutionary back in 1602, and it's the reason modern stock exchanges exist today. But as trading volume grew through the 1800s, even a centralized exchange wasn't enough. Too many buyers chasing too few sellers, or vice versa, caused wild price swings. The market needed someone to step in and keep things orderly. Now, in the 1870s, after the New York Stock Exchange merged with the Open Board of Brokers and adopted continuous trading, a new role emerged. That role is called the specialist. Each specialist was assigned to specific stocks and stood at a designated post with one obligation: to maintain a fair and orderly market. If buyers showed up but no sellers were available, the specialist sold from their own inventory. If sellers appeared but no buyers were ready, the specialist bought. They were human shock absorbers, providing liquidity when the market couldn't provide it on its own. And the role, as you might imagine, was extraordinarily lucrative. Each specialist had exclusive access to the quote-unquote book, the record of all pending orders for their assigned stocks. That informational advantage made specialist firms among the most profitable on Wall Street, and at their peak, a seat on the New York Stock Exchange, which was required to operate as a specialist, sold for as much as $4 million. Specialists evolved into what we now call designated market makers, or DMMs. The role has gone largely electronic, but the principle hasn't changed. Someone must always stand ready to buy and sell so that investors can trade really whenever they want. Every time you sell a stock within seconds, you're benefiting from the liquidity that market makers provide. Now, here's something that surprises most new investors. At any given moment, a stock doesn't have one price, it has two. The bid is the highest price a buyer is currently willing to pay, and the ask, also called the offer, is the lowest price a seller is currently willing to accept. And the difference between them is known as the bid-ask spread. So let's say you're looking at shares of a large company. The bid might be $150 and the ask might be $150.02. That 2-cent gap is the spread. If you want to buy immediately, you're going to pay the ask, or $150.02. If you want to sell immediately, you'll receive the bid, which is lower at $150. The spread is, in effect, the price of liquidity. It's the cost you pay for the convenience of trading right now rather than waiting for a better match. For heavily traded stocks, think of the biggest companies that you know. The spread is typically just a penny or two. But for smaller, less liquid stocks, spreads can be much wider. That wider spread is the market telling you something. Fewer people are trading this stock, so the cost of instant liquidity is higher. Now, here's where the history gets fun. For over 200 years, stock prices in the United States were quoted in fractions, not decimals. If you bought a stock in the 1980s, you might have seen a price like $14.125 or $23.375. Why eighths? Well, the answer traces back to pirate treasure, or more precisely, to the Spanish silver dollar. You see, in colonial America, there wasn't enough British currency to go around. The coin that filled the gap was the Spanish silver dollar, worth 8 reales, where reales being the basic unit of Spanish currency at the time. People literally cut these coins into 8 pie-shaped pieces to make change. This is where the famous pieces of 8 from pirate lore comes from. When you hear someone say 2 bits for a quarter, that's 2/8 of a Spanish dollar, or 25 cents. The expression has survived for over 200 years. When the New York Stock Exchange began trading in the 1790s, the Spanish dollar was still the dominant currency in circulation, so stock prices were naturally quoted in eighths of a dollar, making the smallest possible spread 12.5 cents per share. That convention stuck for over 2 centuries, and by the late 20th century, pricing had tightened a bit to 16ths or 6.25 cents, but the fractional system persisted. Then, in 2001, the SEC mandated decimal pricing in dollars and cents. The minimum spread shrank from 6.25 cents to just 1 penny, saving investors enormous sums annually in trading costs and fundamentally transforming the economics of market making. It also made stock prices a lot easier to understand. No more mental math converting fractions to decimals. Now, what does this mean for you? Every concept we've covered today connects back to liquidity. The Buttonwood Agreement created it. Specialists maintained it. The bid-ask spread is the price you pay for it. And decimalization reduced that price dramatically. Understanding this gives you a practical edge. When you see a tight spread on a stock of just a penny or two, you're looking at a liquid market where trading is cheap. When you see a wide spread of 20 or 30 cents, that's a warning sign. You're paying more for every trade, and you may have trouble selling quickly if you need to. Liquidity isn't just an abstract concept, it's money in your pocket or money out of it. Next week, we'll explore the mechanics of placing a trade, the different order types available to you, and what happens between the moment you tap buy and the moment you own shares. So until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with a colleague, a friend, a family, or a neighbor. The show was produced by Nick Temte, and we'll see you next time on Money Lessons.